Hey, good morning, everyone. Marty Mazzora here. It's Friday, the 14th of February. Happy Valentine's Day to you all. 2025. This will be a relatively brief, I think. We'll see once I get going. End of week snapshot. As for the economy, the latest scoring of our PWA index is slightly in the positive. When we update that for the recent data, I suspect it'll still be right around that area or maybe back to the flat line. Retail sales came in notably negative, notably below expectations this morning. Immediately, bonds rallied quite notably on that, and interest rates came down and the dollar came down, which was interesting because I do think it was probably an overreaction, as there is unequivocally no doubt that the January retail sales numbers had to have been hugely impacted by massive wildfires in Southern California and massive freezing storms on the East Coast. And I should add that December's retail sales numbers were actually revised higher. So not that there isn't some angst in the economy, not that we're not seeing some deterioration in consumer sentiment, because we are, but I think we need to kind of just pause before reacting to the January retail sales number, given nature's impact that I just referenced for you. Okay, so what I want to do today is spend a little bit of time on narrative and a little bit of time on the charts. So with regard to narrative, what I want to do is pull over my recent notes in our own market script or our own internal log. And what I did here is I copied and pasted Peter Berezin. He is an excellent analyst with BCA, Global Asset Allocation Chief, actually. He did a nice job laying out a dozen points of consideration for markets going forward. And so what I thought I would do is just, again, copy and paste his points, and then in blueprint below each point, my comments with regard to my views around what he had to say. So I'm just going to briefly paraphrase what he said and then get into what I'm saying. So his first point is that U.S. payrolls were healthy in January, although the work week in terms of hours worked was down. He said this series can be very noisy, but when you stand back, labor input is slowing. And so clearly BCA, and as you'll see it in point number 2, have a very cautious outlook on the economy and a very cautious outlook on the labor market. My response to that there is that there's really nothing inherently bearish in his ultimately cautious view of the labor market. In fact, a somewhat softer, looser labor market would actually serve as a headwind for rising inflation, obviously, right? So if the labor market is less tight, loosening a bit, then that, of course, can alleviate a lot of upward pressure on wages, therefore can be a headwind for inflation. Number 2, despite the seeming stability of employment growth, perceptions of job availability have deteriorated, yada, yada, and he makes some other fairly negative points there. Here I would simply repeat my comment that I just gave you below number 1, but add that if indeed it gets too bad, right, and the labor market deteriorates enough to flag a recession, there is nothing, absolutely nothing inherently bullish in a recession scenario. Equities are pricing in nothing that remotely looks like a recession. The trade war remains the most immediate threat to the global economy. While Trump delayed implementing 25% tariffs on Canada and Mexico, he did raise tariffs on China by 10 percentage points, which in effect, in one day, was more than he did during his entire first term with regard to China. Now, I do not disagree that a trade war remains the immediate threat. However, markets don't really view it that way, or they don't believe that there's anything durable in these threats. And then I just copied and pasted from Bloomberg yesterday, talking about the dollar. It hit a session low after CNBC reported that tariffs may not go into effect on Thursday and instead may be delayed till April. And I believe that is the case. Whereas as of Wednesday night or Thursday morning, the president said, it's happening now. I guess what he meant to say is, it's definitely going to happen, and I'm going to announce it now. but it's not going to start till April. So markets are just kind of thinking that this is, more negotiating tactics, that they really don't want to put on, massively economically impacting, tariffs on our trading partners. That remains to be seen. As Berezin says here, more tariffs are indeed coming. He announced that they'd be levying tariffs on $50 billion of aluminum and steel imports. These reciprocal tariffs that he continues to talk about, Berezin does make the point that if we take it literally, we're actually going to be reducing tariffs on some countries' goods while increasing tariffs on others, and so on. So as for my response to that one, I had a email conversation with a friend a few days ago, and that was the topic of our discussion. He had mentioned this reciprocal tariffs, making for a fair playing field. And by the way, folks, I do feel like I need to emphasize or reemphasize that, particularly to clients, for our purposes, on behalf of our clients, we unequivocally do not consider politics, or our politics, if you will, in the mix. When it comes to us, you do not want us looking at the world through politically colored glasses under any circumstances, in any way, shape, or form. We have to see the world for what it is, measure probabilities, rewards, risks, etc. So that's what we're doing. So if I, for example, as I will in a minute, speak somewhat bullishly about a place like China, has nothing to do with my thoughts or feelings about the Chinese government. It just has to do with our view of where the risks and opportunities lie. So back to my comment here and my side of the conversation with my friend. The purely reciprocal tariff notion is not necessarily bearish. Keep in mind, the markets are not interested in equilibrium when it comes to trade. If making things even equates to higher prices for U.S. consumers, ultimately, without recession along the way, that's inflationary and bad for markets. Never forget, tariffs take care of select producers at the cost of consumers, and you can debate where those costs lie. But to the extent that some or all of that higher cost is passed on to consumers, they're paying for it. Note that the most protectionist countries typically fare the worst on the global economic stage. And then Berezin goes on to say the prospects for higher tariffs has put the Fed in a bind. Typically, they would look through it. However, that requires that inflation expectations stay well anchored. That assumption is being challenged. Talks about the University of Michigan survey, and I mentioned it in last week's video, and that was before I looked deeper into it. But I mentioned that it just skyrocketed in the last survey, and I suggested that's because of consumers' view of tariffs. Well, actually, when you look through it, Republicans didn't see any inflation at all. Democrats and independents, Democrats in particular, saw a huge jump in inflation going forward. So I'm going to say that noise entirely explains those expectations in that survey. But I do agree that the Fed will have to take it slow until softer data show up. We did get softer data again in those retail sales numbers this morning, and that's why the bond market rallied and rates came down. But I mentioned that there's very extenuating circumstances there. Okay, the best gift that the U.S. government could give investors is a cut to spending. He essentially says if you cut spending, you're going to slow the economy a bit. The Fed can soften its stance, and that would be very, very good for stocks. So that's my third bullet point scenario in those 4 bullet points I served up recently, where the economy slows, rates come down, we don't end up in recession, and stocks continue their advance. However, you cannot have a new protracted trade war in that scenario. No ifs, ands, or buts about it. And in point 7, the problem is President Trump has ruled out cutting spending on the main entitlement programs. He also said he wants to raise defense spending during a recent interview. Discretionary spending outside of defense accounts for only 14% of overall government expenditures. DOGE is promising to radically cut waste and fraud, but so far it has not been possible to really quantify how much actual progress is being made. Meanwhile, President Trump has pledged to not only extend the expiring tax cuts, but to legislate new tax cuts on tips, overtime pay, Social Security, and so forth. So basically, all of this actually would add up to a much wider fiscal deficit and increase the risk of a major fiscal crisis. That paragraph, taken at its face, yes, you'd have to agree with that if that is essentially the right narrative. In contrast to the U.S., European growth remains sluggish, although the PMIs have been improving. I pointed that out. Meanwhile, the region continues to suffer from structural headwinds, high debt, etc. While I don't deny the macro issues for the Eurozone, in a scenario where trade disputes are swiftly resolved at the behest of reacting markets, as has been evident lately, market reacts, negotiations start, and it's not as bad as it was originally presented. I see serious value in Eurozone equities to be realized this year. A Russia-Ukraine ceasefire, which I anticipate this year, would be resoundingly bullish for a region whose equities are trading at a historic discount to U.S. equities. We've had a really good run so far this year in European equities. I should also add a caveat, though, that in a global recession scenario, it's going to be bearish for stocks virtually everywhere. So for European stocks to continue to do well from here, we really need the economy to essentially hold up, and for the Eurozone economy to be essentially bottoming. It is in a different stage of the cycle in our view versus the U.S. Okay, China's economy has benefited from front-running of tariff hikes, right? So people or companies expect tariffs to come, so they buy the stuff they need before the tariffs start, right? So that's going to skew some of the data that we're going to see for the beginning of this year. And but BCA is generally bearish on the Chinese government's willingness to do big bang stimulus, yada, yada. I actually anticipate the authorities to be notably more proactive than Berezin suggests. Or at a minimum, their reaction to economy impacting U.S. trade measures will indeed turn out to be big or bigger bang stimulus than BCA thinks, with the Chinese equity market being a central focus. Again, BCA, just listening to him as recently as this morning, doesn't think that China is all that concerned with their own equity market. I actually would beg to differ. Several of the recent measures were actually focused specifically on the equity market. A government-funded facility designed to actually buy equities, cheap loans to corporations to buy back their stock with. I mean, these are measures directly focused at bolstering the Chinese stock market. But of course, that all remains to be seen. They have massive problems. Everybody's familiar with what's going on in their property market to tackle. Okay, number 10, after strengthening from end September to mid-January, the trade-weighted dollar has been flat to down. The change in the dollar's trajectory has been largely echoed in interest rate differentials, which are no longer unambiguously moving in favor of the greenback. So again, that's if the higher yielding currency, the currency where you can get the higher interest rate tends to be stronger, and so forth. Let's just say they expect a roller coaster ride for the dollar over the remainder of the year with very little clear direction. I don't disagree with that. President Trump's position on the dollar has been all over the map. He says here where on one hand he says he wants a weaker dollar, but all of his policies are stronger dollar policies. I disagree that they're all over the map in terms of what his intent is or what he wants. While Trump's actions, as I say here, or threatened actions would be near-term bullish, I disagree that his position has been all over the map. Clearly, he wants a weaker dollar, but yes, his campaign promises conflict with that end. All the more reason for the market to believe that his actions will not ultimately result in what the campaign promises might have otherwise suggested. And then lastly, his macro quant model, which has been very, very good from the outside looking in. It's neutral on equities. He and his team are actually a little more bearish than the model is on equities, but they agree that it's better to wait for clearer evidence before moving to a underweight on stocks. I agree with his view on U.S. equities. It essentially echoes our current view and positioning. Our core is about 55% stocks. Same view for bonds. However, with regard to non-U.S. equities, I do see value to be had even under present circumstances. However, I'd go nowhere in a big way just yet, as said value would get more attractive should the geopolitical setup deteriorate in the weeks and months to come. And that's kind of the point I made when talking about Eurozone equities. Okay, so folks, I'm going to jump right from there to the charts. And today I want to focus on the longer term charts a little bit. Longer term charts, slower moving. So you got to wait for it. On balance, I think the signals are more accurate, certainly for the longer term investor. So we're going to focus today just quickly on the weekly charts for the equity indexes. The S&P is virtually right at all-time highs on the weekly chart. Each bar is a week, and this is a 10-year chart. This is a notable bearish divergence with a sell signal on the MACD, moving average convergence divergence, and a notable bearish divergence on the RSI. So you have new highs with momentum breaking down. You can see in the past very similar patterns right before a 27 to 30% decline, right before 40% decline. I could go back for decades and you'd see the same sort of pattern. So something to take very seriously in the grand scheme of things. And, it works the other way around, right? Here, we were drawing these lines right as this was going on. And here I was saying we have a bullish falling wedge with bullish divergences. And sure enough, that was the end of that particular brief bear market. As for the NASDAQ 100 index, or in our case here, the ETF that tracks it, you can see basically the same thing, right? You've got your rising wedge patterns and your bearish divergences. We break down below that upward trend line, and that is not a good sign. So we need to stay diversified, and I think we need to stay hedged right here for a lot of reasons, including what the longer-term technicals are telling us. The dollar index, remember we had this bear flag pattern that doesn't really look like one anymore, although it's interesting because this week's news and dynamics and today's retail sales numbers are bringing the dollar down. For today anyway, it's not bullish for equity. Stocks are off slightly as I speak, but here's the dollar going down on falling yields, right? Here's that 10-year yield taking quite the dip the last couple of days on economic news. This was the PPI number. It had a read-through to PCE, which is what the Fed tracks for inflation, that suggests the PCE will come in weaker for January. And then this is today's retail sales number, which the market is choosing to react to, and I think it was probably all about weather. As for gold, folks, remember I said that gold just almost has to correct from here. Well, today it's correcting pretty good. It's down 1.34%. Let me just show you what it looks like on, let's say, a 3-day chart. So here it is falling off a cliff. We actually added some insurance with a put option on our gold position right here because I just felt like it was way too extended. It continued to go up yesterday. Today it's given back all of yesterday's gains, and right here it's kind of battling with where it was a couple days ago. Very, very, very short-term stuff. We are quite bullish over the long term on gold, but from these levels, it could take quite the correction, and it wouldn't take much of a catalyst because the whole world seems to be bulled up in gold. So we have a not small position that we want to make sure if indeed we see a double-digit correction in gold, we don't want to feel it too badly in our client portfolios, and we can buy that insurance relatively cheaply right here. So that's what we did there. And then lastly, I just want to show you just kind of a visual. I've shown this time to time. A few years ago, I created this graph, and it goes back all the way to the Great Depression. I'm going to show you 50 years right here. It's very simple, frankly. It's the daily rate of change for the S&P 500. That's what this scary-looking EKG right here is composed of. These areas that I enclose right in here is where we start really breaking my bands, which are 1% and 2% positive and negative. Okay. So what we're looking for is we're looking for the market to start vibrating a lot, right? And when something vibrates and it vibrates too much, suddenly the rivets start popping and something can break, right? So when you go back to this 50-year chart, you can see right in here, it started to get a little bit scary. We had one breakout above 2%, but the market kind of calmed down in the late 70s, and then it started to get crazy in here, right? It had a 16% decline, bounced out of that, but the volatility remained very, very high, ultimately to culminate in a 27% decline. Right in here, there was a 15% decline amid relatively low volatility, so the market just kind of melted down a little bit right there. Here's a 1987 crash, which nobody saw coming. However, we were seeing quite a bit of vibrations in here before it ultimately broke to the tune of like 21% in a day or something like that. And then right before the 1990, sell-off, wasn't too dramatic, but boy, we were getting a lot of that volatility. So things started really vibrating in here. Then they broke at an 18% pace. Very, very calm during the 90s, a couple of periods, but nothing that really clustered too badly until we started getting in here. And then we started getting clusters of volatility, both up and down, even piercing that 2% band, minus 10%, minus 20%, minus 50%. So a very, very volatile period over the course of those last 2 years of the tech bubble inflating. And then we had a wonderful time right in here, just very low volatility. Stocks just kind of slowly moved their way higher. We did really, really well because of our global exposure, which did significantly better than the U.S. during that time period as the dollar fell. But you can see right in here, we started getting that clustering of volatility, right? And then kaboom, a 57% decline in 2008, but we did get, a bit of a shaking up in here before that ultimately happened. Here we were with, around the European debt crisis, 10, 20, and 11% corrections respectively. And then in that 2014 to 2016, malaise, if you will, there was a lot of volatility along the way that culminated in about a 16% peak to trough decline right in there. And then 2018, the trade war was hot and heavy back in there in 2018. That's when it began. And during that year, we had 10 and 20% corrections at the beginning and toward the end of the year. And then things were somewhat calming down. We did have some gyrations in here, but the Fed was cutting interest rates, but then COVID hit, right? 35%, I think it was closer to 40% for the Dow, but 35% for the S&P. And then in here, while the volatility was going crazy, an 11% decline. 2022, 27%, a little more than that, peak to trough, right, with all this volatility. And we did see it begin to pick up as we were beginning to roll over. But here's my point, and then I'll close. Here we are right now, clearly a clustering of high volatility, enough to put a yellow box around it, but nothing really huge or double digit to the downside just yet. We could get out of this one, obviously, without a massive decline. But if this continues and we continue to get this vibrational action in here, the more that goes on, the more likely it is that we're going to get something to break to the downside. And those longer term charts that I just showed you will ultimately play out the way they suggest they would. So we've got the technicals that are looking a bit sketchy, and then we've got the volatility or the vibrations of the market beginning to show that there's a lot of uncertainty in the market. And when you put all these things together, it doesn't tell us what's going to happen tomorrow or in the course of 2025. It just tells us that this is a time when we need to remain somewhat defensive while also being invested in areas that we think we can make money. And we do get, positive resolutions to this geopolitical angst. I mentioned the Russia-Ukraine situation could be very bullish, particularly for our European exposure and so on. But there's a whole litany of concerns to be addressed this year. So expect more volatility. We're thrilled with our performance year to date, but we take nothing for granted in this crazy world we live in. Folks, thank you so much, as always, for watching and listening. Hope you have a wonderful weekend. Talk to you next week. Bye-bye.